Good evening from Money Matters TV. I'm Paul Sloate, CEO of Green Drake Partners, and with me tonight is Brian Kohute from HJ Wealth Management. Good evening, Brian.
Paul, good to see you.
Good to see you. Well, it seems we can't get away from the emerging markets.
Yeah, emerging markets and bad weather, so I guess we'll talk about both tonight. Yeah, and obviously, as we caution the audience, this show's taped, so don't time anything we say off here, but emerging markets has had a tough 2013, and so far 2014 has been much different. So, and it seems like all eyes are on China. The fear of China slowing down, interest rates going up has shook in the emerging markets. What are your thoughts? You think more damages to come out of the emerging markets, or you think they kind of bottomed out?
Well, I don't know about the stock markets for the emerging markets, but I think the emerging markets are facing some fundamental changes here. They've spent 20 years growing with an export-led growth model, and that growth model won't work anymore. Right. So if we look at China, China's like the poster child for having grown over the last decade at a torrid rate and grabbed an immense amount of global market share, but they can't do that anymore. So now they're trying to transition the economy from an export-led and capital investment-intensive growth to consumer-led. And the only problem is the consumer's too small a piece of the economy.
Right.
So I think there are going to be some more bumps along the way, and I think there'll be some more shoes to drop in China, especially with them being tight on credit.
Right. Yep. Yeah, so yeah, we agree. It'll be interesting. I mean, plenty of opportunities in the good old U.S., right? So most people are focusing their attention there this year and trying to steer clear of the emerging markets.
Yeah, I mean, I think there will be, if we get a real crisis, there'll be an opportunity to invest.
Yeah, right.
And if you look at the emerging markets from a valuation perspective, they're getting close.
Right.
To where you just invest and forget about it.
And like everything else, not every country's bad. There's good stocks over there. You probably need to be a little careful, what countries you're going into. And China's a big part of all the emerging markets. So how China goes, a lot of the emerging markets go as well. So,
yeah, I would agree with that, and I would agree that you have to pick and choose which countries you want to invest in.
Right. Yeah.
So the bond market had a tough 2013 as well.
It did, right? All this taper talk, which I guess we're hearing now, we're doing it. And we'll, I guess we'll talk about Janet Yellen in a minute. We've been, if you went back to our old tapes, we've been saying interest rates are going up forever, right? Finally, they went up last year a little bit. We still believe interest rates are going to go up, which should be tough for bonds. So I think they settled down a little bit here. The rates have gone back down, but long-term rates have to go up. Well, don't know when, don't know who, but it's gonna happen. So.
Well, yeah, the Federal Reserve has said they want to normalize rates by 2017. By normalized rates, they don't mean 2 3/4, 3% on the 10-year. They mean more like 4, 4.5, maybe 5%, which is back where we were in the first half of the 2000s or in the 90s prior to the Great Recession.
Right.
So there's a long way to go from 2 3/4% to 4.5%.
Yeah, I agree. We're in, we've been in a really low interest rate environment. What concerns me is, people have been stretching for yield, and that's where they got burned on their bonds. They went out, 10, 15, 20 years, and they can see now the reality of when rates do go up, those bonds don't hold up their value. And so you're showing losses in a bond portfolio where you're like, well, how did I lose my money in a bond portfolio?
Yeah, we've been recommending people keep their duration short and buy nothing more than a 5-year bond.
Yeah, that's pretty much our fault. Go out 5 years. Risk-return trade-off is pretty good there. You start getting out further, you're taking more risk than you need to. So.
And I also remind people that, if you go out 2 to 3 years, all of a sudden your 5-year bond is a 2 to 3 year bond.
Right. Exactly.
So it's going to look very different, and you're going to get your principal back. So it should be a pretty good risk-reward trade-off. So we have a new head of the Federal Reserve, the first woman to head the Federal Reserve ever. So what's your take on Janet Yellen?
I mean, obviously very well suited and qualified for the job. First showing, market liked what they heard, I assume. So I think she's indicated she's going to pretty much keep Bernanke's policies in play, and they're going to be data driven, which is what Bernanke had said along. We're going to let the data kind of predict our moves.
Right.
So I guess she kind of played her hand. We know where they're headed, but I think tapering's here to stay. They just may pull the levers on and off as they see fit based on the data. So, you see any surprises coming out of?
No,
Yellen
I
or
don't
the
think.
Fed?
The only surprise I think is people have forgotten that Yellen is not as much of a dove
Right.
as I think her reputation.
Right.
I think she was a dove for a reason, but if you go back to the 90s, she was a little more hawkish if you go back then. So if you look at her history, if the economy does start to grow more strongly and employment picks up and unemployment continues to drop, and one of the interesting things about those employment statistics, the government publishes 2 sets of employment statistics, right?
Right.
So if you looked at actually the household numbers, while the survey said 170,000, the household numbers said 500,000. So somewhere in between is reality, and I think what the Federal Reserve is looking at is data which we can't see that support their tapering because maybe employment growth is stronger than the headline numbers are suggesting. But I expect Janet Yellen to be less of a dove than people think.
What did you take of her first speech? I mean,
Classic Fed speech.
right. So
she said everything.
stuck to the party line, right?
Everything you could have read in any of the pieces they've been putting out over the last 6 months, and it was classic. This is what we're going to do it. But if the data say something, we're going to do something different.
Right. Yep.
So I call it classic Fed speak.
Yeah, I think no surprises, which was good. The market doesn't like surprises, obviously.
No, it doesn't. So Q1 weather has been pretty tough.
Yeah. Again, I guess we're bracing for another one here soon. So yeah, it's going to be interesting. Especially on the Northeast, and even parts of Central. It's going to have an effect on the economy, no doubt. What's you're a numbers guy. What do you think the impact's going to be?
Well, I think you've got 2 definite impacts. One has got to be on construction starts.
Right. Yeah.
I mean, with all the bad weather, and frozen ground, where last year we had no winter, so people could start building early. I think the comparison is going to be tough year over year. So I think construction starts will probably be harmed. I mean, the other part is I think retail is going to be harmed. Because people are not going out
Nobody
to
wants to leave
buy.
their house.
One, they're not going out of their house, and number 2, they're not going out to buy spring clothing when it's 15 degrees out. It's just not going to happen. I mean, the weather's got to warm up. So, the retailers could have a tough February, and if the weather continues cold and snowy, they could have a tough March as well. So the whole first quarter for retail could be real tough.
Yeah, unless you're a Home Depot or a Lowe's, where
well, Home Depot can't keep salt in stock today.
That's true.
So that's pretty good. So oil prices have been creeping up.
Right. So yeah, it's been interesting. Do you think it's speculation, or do you think it's a more global sign of the demand?
I think it's a little of both.
Okay.
So yeah, I think global demand's picking up because Europe's growing. Remember, and Japan is growing. Which is a shock.
Speaking of Europe, worse behind Europe? I mean, they seem like they kind of settled down a little bit here.
I think for the short term, the worst is behind Europe. However, and this is a big however, if Europe doesn't get its act together and grow at a faster rate, you'll have a number of countries that might really consider leaving the Eurozone.
Right.
Because, for example, Italy's industrial production today is back to where it was 15, 20 years ago. So if the Eurozone continues on this track, that's a bad outcome for Italy.
Right.
So, and also in Greece, the expectation is in the next elections, which will occur this year, the party that wants to exit the Eurozone is going to win. So I don't think Europe's smooth sailing, and I think that the Bundesbank is going to have to relent and allow the ECB to do some form of quantitative easing. And if it doesn't, what will happen down the line is I think there's going to be more and more pressure to dissolve parts of the Eurozone.
Yeah. I know you've been in our lifetime. It's probably somebody's going to succeed from the euro, right?
Well, the UK already said it wants to leave
it did, yeah.
the Eurozone.
Right. So, yeah.
They never joined on a monetary policy, and now they just want to leave in total.
Right, altogether. So I took you off oil. Is it going up or down?
Well, our view is it's in a big trading range.
Okay.
Low end's like $80, high end's going to be like 120, 130. And it's just going to kind of trade in that range because the economics of oil say when we get up around 120, 130, it slows the global economy. And when we get down around 80, that's kind of where your high-cost producers are, so it's not going to go much below 80, maybe $75.
Right.
So they'll shut capacity. So you're kind of in this, I think, big trading range for a while.
Yeah, it makes sense.
It's not that I'm bullish, I'm not bearish, I just think it's going to be a big trading range.
Yeah, and there's a shift, right, with the U.S. going on with oil. So there's, I know natural gas hit a kind of an all-time high here. So
well, not an all-time high. It hit a near-term high because the weather.
Right.
So yeah. So energy is. I see natural gas prices going up over time, and I see oil prices going sideways.
Yeah, that makes sense.
Which is kind of what we've been saying for a long time. So the equity markets had a little stumble in January.
Yeah, they did. They did. People were blaming on the emerging market contagion fear, which I don't know. My take was the analysts kind of got a little rosy on expectations, and they kind of were under all last year expectations, set the bar low, and then they kind of set it probably a little higher than they should have. Companies had decent earnings, not through the roof, but pretty good earnings, and a lot of them didn't hit expectations. So I still feel pretty good about it, and I'm an advocate that you have to have some of these consolidations to move forward. So a correction's not the worst thing that can happen to the market. So
well, we hadn't had a correction in 15 months?
Yeah, it's been a while.
Which has been a long time for the market. Usually you get 2 or 3 corrections in a year.
Right. So.
And we had none last year. The market went basically straight up.
Yep.
So, yeah, we agree with you. We found that valuations got a little stretched at year-end based on what companies realistically can do. And if you look at the earnings that have been reported, a lot of companies have actually lowered their guidance for 2014. Right. Yeah, we thought their initial guidance was high, and what's happened? They've all had to lower guidance because it wasn't going to happen.
No. Yeah, we still have a jobs problem, right? Jobs, the growth still isn't as high as anyone would like it, and it seems like a lot of companies are still hitting the bottom line by layoffs, rather than, reinvesting in the future. But they have a lot of money on the sidelines. It's going to get to work soon.
Well, what we're starting to see is corporate America starting to spend money. So I think that'll be a good thing for the economy because they've really been underinvesting capital in the United States. And our impression, especially having spoken to a number of CFOs of larger companies, is that they are going to start opening the spigot just a little bit this year. It's not going to be a torrent.
Dipping their toe in the water?
They're going to dip their toe in the water and spend a little more money. And I also think part of what will get them to spend money, they're going to spend it on robotics. They're going to spend it on moving to the cloud. They're going to spend it on things that are going to drive productivity, but they're going to start to spend, and they also need to add a little bit of capacity.
Right.
Because some of them are running pretty lean on capacity, so they're going to start running out of the ability to service their customers. So that's a problem.
Got you.
When you can't deliver to your customer,
they're never happy.
They're never happy. So it's time for our question from the viewer.
All right.
Our question this week comes from Tim Keller from Pottstown. And his question is, what are the advantages of buying inflation-indexed bonds?
Yes, so a traditional bond you buy for a fixed period of time, and it pays interest at a nominal rate, 3%, 1%, 2%, whatever the number is. Inflation-protected bonds, commonly called TIPS, Treasury Inflation Protected, you get a nominal interest rate, but you also get an adjustment for inflation. So they do really well when your expectation of inflation is rising. You get a higher return, but it's meant to really be a good hedge against inflation. Now, given that said, with what the Fed just said, that inflation's not rearing its head and it's not around, it's probably not the best place to deploy money right now.
Well, yeah, bonds may not be the best place in general to deploy money.
Exactly. So, but yeah, that's the pros of them. So,
if you'd like to have a question asked on the air, please write to Money Matters TV, 205 East Levering Mill Road, Ballackinwood, PA 19004, or email us at moneymatterstv@gmail.com. And now I'd like to welcome our guest. Our guest tonight is Jane Scaccetti. She is with Drucker and Scaccetti, which is an accounting firm. Good evening, Jane.
Good evening. Thank you for having me.
Jane, how are you?
Good.
So, why don't you tell us a little bit about your firm and some of the tax changes you've been advising your clients on for 2013?
Thank you. So Drucker and Scaccetti is an accounting firm, but a rather unique one. Our focus is solely tax. We use the term the tax as a business strategy. We represent complex individuals, large companies, primarily relationship driven, where an individual may have multiple companies, businesses, investments, family wealth, and help them both prepare and file tax returns as well as do advice that is around taxes. And we've been busy because there's a lot going on.
That time of the year too, right?
Well, you know, for a number of years, from 2011, there was talk about changes, and then 2012, and then 2013, there was actual changes in the tax law. So there was periods of time where there were patches done to the tax law, and some of that impacted individuals. And there was difficulty in planning because you didn't know what was going to happen. And then a law change, which really increased and has its greatest impact in 2014. So, you know, some of those changes are tax rates are going up, you know, from a maximum rate of 35% to 39.6%. But that's not the whole story. There's a 0.9% tax on earned income that hits at the higher levels at $200,000. There's a net investment income of 3.8% that will be taxed on your interest, dividends, capital gains, rents. And then you have the reduction in itemized deductions and the phase out of itemized deductions. So you have more of your income being taxed, and it's being taxed at a higher rate, and different kinds of income are being taxed in different ways, and the threshold hits at different numbers. Mostly for, you know, you start to see some of these new taxes, the 3.8 and the 0.9% hit on a joint filers that have income somewhere around 200 to 250,000. And for joint filers, if they do have income in excess of 500,000, then everything is hitting.
So it sounds like your client base is going to get hit pretty hard, all things being equal. You know, if they're kind of at the same year they had the year before, they're going to pay a lot more in taxes this year.
A lot more. And in fact, what happened last year was I had prepared a tax return for a client, and a substantial client, and her W-2, we'll make it simple, her W-2 was $1.3 million. So a substantial amount of income, and I had to call her and tell her the amount of tax that she owed and made sure she had pulled over from driving before I told her, because it was a big number, right? But that total tax for her was $413,000 on $1.3 million. And she had some itemized deductions, nothing fancy, nothing sexy, just a normal high wage earner taxpayer. So for the heck of it, I threw the numbers into our software program just to run it on the 2014 rates, just to see if she had the same $1.3 million of income, if she had the same itemized deductions, how much more would she owe in tax? And her tax went up by $62,000. So even though $1.3 million is a lot of money, $62,000 is as well.
Still a lot, yeah.
And you know, there's a lot of changes in this tax law that aren't things that people are anticipating. For example, we have seen it in 2013. While these rates went up, many of the withholdings did not change. So what you have are the rates going up, but the withholding rules were soft. So there used to be a maximum of 25% on bonuses. It went up to 28. A lot of people didn't realize that. They were still withholding at 25. The bonus increases didn't necessarily trigger for an employer until it had reached a certain threshold. So you might have had 2 wage earners that are married that are earning, and you didn't get to that threshold fast enough. Or you may have had a bonus earlier in the year and a bonus later in the year. But what we're seeing is a lot of people are under withheld. Their taxes are going up because the rates have gone up, additional taxes on more income, and they've lost their itemized deductions. So you guys are the experts in the market, and I know it's primarily institutional driven, but I think there's a lot of people that are going to be cashing out of the market over the next couple of months because they have to pay taxes.
Well, there's anecdote, that's been my expectation, is there's going to be a lot of surprises in April when they get their results from their account and say, oh my God, what happened?
Yeah.
Right?
There really is. And then that creates another problem, because even though the market's been soft lately, as you were saying, You do have the issue that if they cash out of the market, in most cases they're going to cash out and have gains.
Right.
So now they have taxable
Double
gains,
edged sword.
which
Double
drives the
whammy.
tax.
Yeah.
Well, and that is a big problem. And one of the things that we try to do, a hallmark of our firm, is that we're not just looking at taxes, we're looking at cash flow and how it impacts the individual and the family unit, how it impacts trusts, how it impacts a lot of issues so that you're planning for it. But even when you plan for it, and people, they've taken sort of a, if I don't look at it, it's not going to happen.
Kind of
So-
like the ostrich in the
A
sand.
little bit, but as someone explained to me, well, you have your head in the sand, the other end of you is sticking up. So, maybe that's not wise.
That's true.
So you've given us a sense of the magnitude of this. So maybe you could talk a little bit about how, individual wage earners going forward can sort of protect their income from some of these tax changes, how they can plan for this, how they can, affect their withholding so they don't have a problem starting in April 2015 as well.
Yeah, so there's a couple of things. One is, you always try to pay less tax. You try to get yourself into a lower tax bracket. So sometimes an individual might have the ability to postpone certain bonuses or transfer from one year to another and sort of flatten that out and try to keep themselves down at a lower threshold. Short of that, which is sometimes very difficult for someone to do, they can make sure that they have the right withholding rates so that their cash flow is being planned properly. But aside from that, there are ways to shelter some taxation dollars, and your investment advisors are a key element of that. There were people, almost everyone has used up their capital loss carryforwards that were created in the past. Not everyone, but almost everyone.
Some floating around.
There
still.
are some floating around still. So when you do have that, it's important to remember that maybe what you want to do is, trade in those bonds while you can take a capital gain that you can offset with your capital losses, as opposed to continuing to hold them and generate interest income. Some of the tax rates, could be as high as 43, 45, 48%, depending on which city or state that you're living in. So it's a substantial number. Right. You also, if you have appreciated securities and you're charitably inclined, gifting appreciated securities as opposed to cash is a great tax shelter, because the gain on those securities are never taxed. You just, if you have if you bought Apple at 100, and it's now worth 120, and you gift it, you get the charitable donation of 120, but you don't have to pay any tax on the gain of 20. So it's a substantial benefit, and it's often ignored. People will sell the stock and then try to donate the proceeds, and they end up with a tax gain, and in the end, less dollars to donate. So there are the little planning things that you try to do. Alternative minimum tax is tough, especially in this region. A lot of people work in the city, so you have both the city wage tax and you have your state and local taxes, which drive the ability of you falling into the alt-min trap. When you fall into that, you lose your personal exemptions. A lot of your deductions aren't benefiting you. You get into a maximum tax on more of your income, even though it's called a minimum tax. It's not a pleasant thing. So, there's things that you do need to do and to plan around. Retired individuals looking at their portfolios and looking to drive more to dividends as opposed to interest, because dividends still are taxed at a more a lower rate than ordinary income.
So I've been a huge fan of the Roth, and I guess now with the rates going up so much, I'm starting to wonder, you really got to run the numbers, right, to see if the Roth benefits versus, where do you guys fall out, Roth versus the traditional pre-tax?
So, that's a tough one. I think it depends on how old the person is and how long to retirement. I think the younger the person and the longer period of time that you can contribute, then I think the Roth can almost always be a winner. Right. But I think when you start to get to people that are older, people like me, if you are in that tax bracket, then to take the deduction now might be beneficial. It's a tough one. It really depends on how long you're going to earn, right? Yeah. And have that earning capacity, not so much what rate you're in now versus what rate you're in later.
Right.
And it also depends on whether you need to take that money. So, some of our clients, their Roth may never use it, and it's going to pass on. And in that case, that's a beautiful thing if it's a Roth, because you can possibly pass it along to another
That's why you
generation.
say there's two extremes where the Roth's compelling and everybody's in the middle is kind of got to run numbers and figure out.
You do.
Yeah, so.
You do. Are you finding that some companies are not offering the Roth with the same kind of?
I'm shocked that not every retirement plan has amended it to add the Roth feature.
Yeah, that's been my experience as well. And even when they do, there still seems to be a reluctance to really explain what the benefits would be.
They're not educating employees that it's actually even a viable option.
Right.
Yeah, I mean, we manage a lot of retirement plans, and the ones we do, we add the Roth, but I come across clients, I'm like, well, do you have a Roth feature? No, I don't think so. And
well, then you have all the skeptics who are convinced that in some fashion they'll pay tax on it anyway.
Yeah, right. They'll change the law.
And I'll lose the deduction and I'll still pay a tax, so maybe at least I get right. Exactly.
Right.
Exactly.
So if we were to look at what they've done with the tax code, how similar or how different is this to sort of the rates that people used to pay in the 90s before they dropped the tax rates? How much is this just a restoration of what we used to have in the 90s?
No, that's a good question. And I saw an article a while back that really tried to quantify whether or not tax rates have gone up and are you really paying more in taxes. And my recollection on that article was that they sort of came down on no, because you had more deductions and you had higher rates. When I started my profession, tax rates were at 70%. But there were a whole host of deductions that were allowed that offset that. And there were maximum taxes on earned income. And so that 70% rate really was on dividends and interest, which is the exact opposite of the philosophy that you have today, where you tried to keep your tax on investments lower. But again, that also was impacted by what corporate rates were. So if corporate rates were lower, then you had a higher individual rate, almost like a pass-through kind of concept, so that the tax was being paid by the individual versus the company. I do think from 1990 to now, not 1990, let's say from 2000 to now, people are paying more in taxes. And part of the reason is because the states and local taxes have really become robust. And they are really looking to take every nickel out. And we see an increased amount of audits that are going on at the state and local level, very aggressive pursuit of tax dollars. So yes, the federal, I think, has gone up. The deductions have gone down and rates have gone up, but there are still a lot of little sheltered areas where you can shelter some of those dollars. So I'm not sure in the end for everyone it's more, but I do think when you add the state and local in there, then clearly you're paying more taxes today than you did before.
The state and local have clearly gone up because they've got this big Medicaid burden that's blown a hole in their budgets, and the only way they could
they have a lot
fix
of,
it.
They have ice and snow removal burdens, and they have teachers and pensions, and they have pensions for city workers, and they have state, and so there's a number of reasons, and for no matter what the reason is, it's resulted in more taxes and a more robust system to collect those taxes. With technology now, most things are e-filed, and it's very easy to spit out notices because something's not matching, but way more aggressive with a little more effort.
Right, exactly. So, I think we're running short of time, so I don't know if you have
Well, maybe one last question. If you were going to give individuals a piece of advice on how to think about their taxes for the next couple of years, what would that be?
I think planning. Planning is really, really key. I think if you sit down and you work with someone and you start to look at what your taxes, what your income would look like over the next couple of years, what are your goals, what are your investment objectives, how do they interact and play into your taxes? Around the table should not be just your investment advisor. Around the table should not be just your tax accountant. Around the table shouldn't be just your estate attorney. They need to work together if you're trying to build family wealth. And in the end, that's what you're trying to do, whether it's a corporation that's closely held or family-owned business, even if it's just a large company and you're an executive, a senior executive, whatever it may be, you're trying to plan, and planning and sitting down and looking at the different opportunities and seeing which ones can be meshed into your goals and something you can execute on is the best strategy, I think, for controlling tax.
Well, that's excellent advice for anyone.
Good.
And unfortunately, we have run out of time. Our guest next week is Stephen G. Nappy. He is the Associate Vice Provost at Temple University, and he is in charge of their business and entrepreneurial programs. And from all of us here at Money Matters TV, your money matters.